Nika, thank you to the entire outreach team for putting on an incredible boot camp so far, and really excited to share this information with you all tonight. We know that so many folks have been worried, concerned, trying to figure out how to make how to return to repayment in the best way for them, how to manage their student loans. We haven't had to make payments for 3.5 years. So this is a big transition time for so many folks. We understand that. We want to make sure that you have the tools and resources that you need to manage your student loans now and going forward. So we're going to share a lot of information. We're going to have some questions and some knowledge checks. We're going to have some demos and we're going to have a good time. So we're going to jump right in. We can go to the next slide. So a little bit about what we're going to do today. We're going to do a repayment refresher. We're going to talk about your StudentAid.gov dashboard. We're going to talk about public service loan forgiveness and the payment count adjustment. We're going to talk about this new affordable income-driven repayment plan, the Saving on a Valuable Education Plan, the SAVE plan. We're going to talk about IDR plans generally and how to apply, talk about next steps, and then we'll have some Q&A. Let's go to the next slide. All right, managing your federal student loans. Next slide. As you know, because of legislation passed by Congress, the federal student loan payment pause ended September 1st. People started getting bills last month and bills became due this month. I know many of you have already had bills. People have already made payments. And so unless you were on your automatic grace period because you left school within the last 6 months, your first payment is due sometime this month. So you should have received a billing statement from your servicer, usually 21 days prior to your bill date. The servicers that work with us are listed below. You may have gotten a bill from multiple servicers because you could have multiple servicers. It's not too late to sign up for auto pay if you have not done so. Auto pay enables you to make sure, take the worry out of missing your payment from month to month, and it saves you a little bit on interest if you sign up for that. If you were enrolled before the pause, you do have to re-enroll now. And you just want to make sure your contact information is up to date with your servicer and on StudentAid.gov if you haven't done that yet, because we want to make sure that we have the best information to reach you with the most up-to-date information. Let's go to the next slide. So when you go to StudentAid.gov, we have done a lot of improvements. And so when you go and you see your dashboard, that's the best place to go to start with your loans. If you're wondering, where should I start? What do I do? I don't know. What's going on with my loans? Start at StudentAid.gov. Right on your dashboard, as soon as you log in, you'll be able to see your aid, your grants, your loans you've taken out. You'll be able to see who your servicers are and the upcoming payment and the amount, so you'll know where to go for next steps and to make your payment. You'll see your activity. So if you've applied for things like PSLF or borrower defense, you'll be able to check your application status right there. So much is on that StudentAid.gov dashboard. And it's a great place to start if you want the basic information about your student loans. Let's go to the next slide. And so also on that StudentAid.gov dashboard, you can delve more deeply into your loans. You'll be able to see a loan breakdown. And so you'll be able to see what type of loan you have, how much it is, the interest rate, the balance, and you'll be able to delve into each specific loan that you have, not just see the overall balance. Let's go to the next slide. And there's some checklists with helpful resources for borrowers, like about preparing for school or return to repayment or information for parents. Let's go to the next slide. So, common question that we get is, what is a grace period? So for most federal student loans, let's go back one, sorry. For most federal student loans, when you graduate or leave school or drop below half time, we automatically put borrowers into a 6-month grace period before you have to make payment. So if you graduate in May, usually your first payment won't be due until November or December of that year. We want to give you a little bit of time to get ready to make those payments. So there is a 6-month grace period, and you can waive that grace period. And for most unsubsidized loans, interest does accrue during your grace period. So keep in mind, you can waive it, but you have to actually waive it. But if you're in that grace period, you don't have to make payments. Next slide. We get another question about, how are my payments applied, right? You may pay hundreds of dollars each month. And you want to know, where is this money going? So generally, like most loans, when you pay monthly payments, we pay your interest first and your principal second. So if you have a monthly payment amount of $100 and your loan balance, the principal balance, is $5,000, and you accrued $25 that month, $25 of the $100 you paid goes to that interest. The other 75 will go to the principal balance, so it'll go down to $49.25. Now, if you did not cover that interest, your principal balance would stay the same. Your principal balance cannot go down if the amount you paid is not more than the interest that you've accrued. Now, for some of us, we've been in repayment for a while and we have a lot of interest that built up, unfortunately. So for many of us, we do make payments and they don't touch that principal. We're going to talk a little bit about the benefits of the SAVE plan on interest accrual shortly, but just to note that that is how your money is applied when you make your student loan payment. Let's go to the next slide. We get a lot of questions about borrowers who have in-school deferments for grad schools while they're in grad school, and do they need to make payments on their undergrad loans? So when you go into school, usually full-time, more than half-time, we will automatically put you on in-school deferment on your prior loans if you've gone back to school. So you don't have to make a payment when you're not in-school deferment, but you won't be making any progress towards loan forgiveness or loan repayment either. And we know a lot of folks go to grad school and also work part-time or full-time. So if you want to leave in-school deferment for grad school early, you can just ask your servicer to take you out of that deferment. Now, you can't ask to be taken out of undergrad deferment if you've never been in repayment before, but you can be asked to take it out of deferment if you're in grad school and they put you back into in-school deferment. And depending on the loan type, you still may be responsible for the interest that accrues during that deferment period. You can learn more on our website. Let's go to the next slide. Okay, so if you are repaying student loans for the first time, so you left school during the payment pause or your grace period ended during the payment pause, your first payments are also due this month. Monthly payments amounts will depend on the repayment plan that you choose. So if you have not yet chosen a different repayment plan, you've been automatically placed on the standard plan. It's not too late though. If that standard plan payment is too much, it's never too late to go to our website and sign up for an IDR plan, an income driven repayment plan. And we'll talk a little bit more about that now. And you can still be preparing, looking at your repayment options, using our tools on StudentAid.gov, like Loan Simulator, so you can make the best decisions for your circumstances. We'll go to the next slide. So we're going to transition now and talk about public service loan forgiveness, or PSLF, which is one of my favorite things to talk about. So PSLF is a program that provides loan forgiveness after 10 years or 120 monthly payments for folks who work in certain qualifying public service fields. And whatever you have left over at the end of that 10 years of repayment and service is forgiven and it's not taxable income. So we're going to delve a little bit more deeply into PSLF. We can go to the next slide. So we're going to start by the loan types. So if you're trying to get public service loan forgiveness, the first thing you need to know is, what type of loan do I have? And you need to have federal direct loans. And remember, you can find out exactly what type of loan you have on your StudentAid.gov dashboard in your loan breakdown. It'll say what type of loan in the title of the loan. But you need direct loans for PSLF. And that does include direct consolidation loans and Parent Plus loans. It doesn't include FFEL program loans. FFEL stands for Federal Family Education Loans. These are loans that were made by private lenders but guaranteed by the federal government. It also doesn't include Perkins loans. These are loans that were made by institutions of higher education but guaranteed by the federal government. It doesn't include any other federal or private student loan. So for PSLF, you want to have direct loans. Now you can consolidate FFEL or Perkins loans into direct loans, but you have to do that if you're trying to get PSLF. Let's go to the next slide. So that's what type of loan you have to have. Now, what makes a payment count towards that 120? So it has to satisfy the full amount due for that month, has to be made on the right repayment plan, which includes standard or income-driven repayment or any income-driven repayment plan. It can be non-consecutive, so it doesn't have to be 120 payments in exactly 10 years. You don't have to do everything in a row. Your life is messy, life changes. You can switch careers, you can take time off, doesn't matter. You just have to get to 120 however you get there. And it can include certain periods of forbearance or deferment. Now, I should say that I am giving you the basic rules of PSLF, how it normally works, so you know how it normally works. But I am going to talk about some programs that have like some special pieces that affect PSLF today. But this is how PSLF works in the normal course of things. So for a payment, if it's for it not to be eligible, if it doesn't satisfy the full amount due for that month, if it's made on the wrong repayment plan, like a graduated plan or extended plan or an alternate repayment plan. And it doesn't include payments made if you made them when they weren't required, like you were still in an in-school deferment or you were in that grace period. Let's go to the next slide. So we talked about the loan, we talked about the payments. Let's talk about the employment. So we define public service very broadly. We define it as any service for any government entity, that's federal, state, local, tribal, which includes military, public schools, all of those. It includes all 501c3 nonprofits, and it includes some other nonprofits if they provide qualifying public services. And we'll talk about a little bit more about that next. And it has to be full-time, which we define as 30 hours a week or more on average. Now, we know 30 hours a week for some employers is not their definition of full-time. But for us, you only have to work an average of 30 hours a week, and we consider you full-time for PSLF purposes. So for the employment not to count, it can't be part-time unless you're working multiple part-time jobs at all qualifying employers, and it adds up to 30 hours a week. Doesn't include volunteer work, so if you're not getting paid, doesn't count. Doesn't include work for any for-profit entity, no matter what you do for them. Doesn't include labor unions, and doesn't include partisan political organizations. You can go to the next slide. So that's the basics of PSLF. And I mentioned that there are some special things going on right now that impact PSLF. That's how PSLF normally works. So if you're trying to get on, if you are working towards PSLF forgiveness and you want to be on track for the long term, you want to make sure you're meeting all those requirements. But if you've been in repayment for a while and you've also been working in public service and some of those things that I laid out don't apply to you, you're in luck. Because right now we're in the process of doing something called the payment count adjustment. Now, if you are familiar with the PSLF waiver that we did last year, you may remember that we waived some of the rules for normal PSLF. The payment count adjustment acts similarly to the PSLF waiver, but there are a few differences. And so under this payment count adjustment, borrowers can get credit for past periods of repayment, forbearance, or deferment that normally don't qualify for PSLF or IDR forgiveness. Now, when I say IDR, I mean income-driven repayment. And you'll hear me say that acronym quite a bit. And it applies to anyone with a loan held by the U.S. Department of Education, even if the borrower is in default or they have a Parent Plus loan. So basically, if you were on the payment pause, it counts. And if you still have federal family education loans, those FFEL loans we talked about, those guaranteed loans, whereas normally if you consolidate it, it wouldn't count, but you had to do that to consolidate for public service loan forgiveness purposes. Under the account adjustment, you'll be able to get credit for that time when it was still a FFEL loan. So, like I said, those are we talked about the PSLF rules normally, but right now there's still an opportunity if you don't have loans that are direct loans to consolidate into the direct loan program to take advantage of this. So the payment count adjustment includes any months in a repayment status, regardless of whether you made a payment, the type of loan you had, the repayment plan you were on. It only does not exclude periods. It doesn't include periods in default. It's for direct loans, FFEL loans, and program loans that have any time in repayment prior to becoming a consolidation loan, even if you consolidate them multiple times. So we're going to count that time on the underlying loans. And it includes some forbearances and deferments. Go to the next slide. So the biggest piece of the count adjustment, and one of the reasons why it was necessary for us to do this, is because we recognize that for a long time, people were steered into forbearances when they could have been on income repayment and had a $0 or low dollar payment. We recognize that there were a lot of servicing errors. We recognize there was inconsistency in how we were counting payments. And so we're giving credit for long-term forbearances, which we define as 12 or more months consecutive or 36 or more months cumulative. We're giving credit for deferments prior to 2013, as long as it wasn't an in-school deferment. We're counting all economic hardship deferments, some military-related forbearances and deferments, and we're even counting some short-term forbearances, but that's a separate process. It's not automatic. Let's go to the next slide. Okay, so the payment count adjustment is going to happen next year. If you still have FFEL loans, or Perkins loans, you can consolidate by the end of the year. You should do it by the end of the year just to make sure you can take advantage of this so you can get the full benefits of the adjustment. If you have direct loans, you don't really have to do anything. If you have FAIL loans that are owned by the department, so they were on the payment pause, but it says FAIL, but you're not trying to get PSLF, you also don't have to do anything. But if you still have FAIL or Perkins loans and you're trying to get PSLF, or just get into the direct loan program and get the benefits of the payment count adjustment, and they're not ed-held loans, then you need to consolidate, and you should try to do that by the end of the year. So we're going to do a quick return to repayment pop quiz. And I think, is this one where they, people actually answered? I think so. Maybe?
No, go ahead. No.
Okay. Sorry. So true or false, if a borrower graduated in May 2023, so May this year, and is currently in their grace period, their first payment's due date was set for October 2023. Oh, that's a tough one. Drop it in the chat what you think the answers are. So the answer is false. The grace period lasts for 6 months. So that borrower's payment period would begin in December 2023. Remember, just because payment started in October, people still get their full grace period if they just left school. Go to the next slide. All right, pop quiz number 2. If a borrower is repaying FAIL loans, which of the following should they do? Should they A, consider consolidating their loans, B, see if they qualify for loan forgiveness options such as PSLF, which may require consolidation, review the payment count adjustment, or D, all of the above? Everybody got the answer? The answer is D. If you have a FAIL program loan, all of those actions would be excellent actions to take right now. All right, let's go to the next slide. So we talked a little bit about managing issue loans, repayment basics. We talked a little bit about public service loan forgiveness, the payment count adjustment that's going to occur next year. And we're going to talk about the Saving on a Valuable Education Plan, the SAVE plan. That is this new affordable income-driven repayment plan that was recently unveiled by the Department of Education. Go to the next slide. So the SAVE plan for most borrowers is the most affordable plan ever. It replaces the revised pay-as-you-earn plan. So if you were previously on that plan, you've been automatically transitioned to the SAVE plan. You don't have to do anything else. And this SAVE plan, like other IDR plans, calculates your monthly payment based on your income and family size. Next slide. And so it offers a lower monthly payment for most folks than other IDR plans. And here's why. So first, it protects more income for basic needs. So if you earn $32,800 or less as a single borrower, or $67,500 as a borrower with a family of 4, you are eligible for $0 monthly payments. Borrowers earning more than that will save an average of $1,000 a year, but more folks than ever will be eligible for a $0 payment on the SAVE plan. And that $0 payment still counts towards IDR forgiveness and PSLF forgiveness, but it protects more income for folks' basic needs. And this is more than is protected under other income-based repayment plans. It also has an interest subsidy. So we talked earlier about how some of us have been paying our loans for years and continue to watch our balances grow because the payments we're making aren't covering the interest. Under the SAVE plan, you no longer have to watch your balance grow and grow. We're going to help you with that. So as long as you make your required monthly payment, the payment that is based on your family and your family size and income amount, as long as you make that payment, whatever's left over in interest for that month, we will cover. So whatever payment you make, if it doesn't cover the interest that you've accrued that month, we will cover the rest. So your balance will not continue to grow. You just have to do your part, and then we'll help with the rest. We've also made sure that we've limited interest capitalization across the board for borrowers to make sure that balances aren't growing and you're not getting interest on interest and you're watching your balance grow that way. We've made it so that under the SAVE plan, like other IDR plans, if you are married and you are filing separately, you don't have to include your spouse's income. Let's go to the next slide. And there's going to be additional changes for SAVE next year. So SAVE is really good right now. It's going to be even better next year, so stay tuned. So here are the common questions we get about the SAVE plan. If a borrower enrolls in the SAVE plan, will they still qualify for PSLF after 10 years? Yes. SAVE is one of the qualifying repayment plans for PSLF, because for PSLF, you want to be on the standard plan or any IDR plan, including SAVE. So you can absolutely do both. Is interest eliminated for all types of subsidized and unsubsidized loans, including graduate school subsidized loans? It's a good question. So interest is not eliminated. It's more that you're still accruing interest. We're just covering any part of that monthly interest that you can't, that is not covered by your payment. So you won't continue to build up interest and build up your overall balance. Is there an income cap for the new SAVE plan? No. Unlike some of the other IDR plans where you have to have a partial financial hardship, anyone can apply for the SAVE plan as long as they have direct graduate or undergraduate loans. So absolutely anyone can take advantage of SAVE if they have grad or undergrad loans in the direct loan program. So next slide. So here's a quick chart that helps you estimate how much a borrower will pay each month under SAVE. You can go to the next slide. Let's do an example scenario. So we got Sarah. Sarah is a single parent with one daughter, and she's been making student loan payments of $87 on and off for the past 5 years. Sarah is currently on the pay-as-you-earn repayment plan and makes $40,000 a year. What would Sarah's new monthly student loan payment be if she switched to the new SAVE plan? So let's figure it out. So when we look at this chart, we're going to go, Sarah makes $40,000, and we see that she would have a $0 payment according to this chart. So that's estimated. We don't know everything about Sarah, but based on what we know, she would have a $0 payment under SAVE versus the pay-as-you-earn plan. Okay, let's do a quick pop quiz. Next slide. So we got David. David is a mechanic who enrolled in the Repay plan before the student loan payment pause. At the beginning of the pandemic, with no changes to his income, David started saving for a new house. With student loan payments restarting in the fall, David is concerned that his payments will be too high, and he wants to make sure he's on the plan with the lowest monthly payments. Next slide. So the question is, what action does David need to take? Does he A, need to enroll in the SAVE plan? B, switch repayment plans? C, make no payments once repayment resumes? Or D, take no action? Put the answer in your brain. The answer is D, take no action. So the good news for David is he was on Repay before. He's automatically being transitioned to SAVE, and his new monthly payment, we calculate it based on the new SAVE rules, so that with more income protection. So his payment will be lower. So David doesn't need to do anything because he was already on the revised pay-as-you-earn plan. Let's go to the next slide. Now we got Mia. Mia is a single parent with two daughters, one of which graduated from college this year. To afford her daughter's tuition, Mia and her daughter each took out student loans. So Mia took out a Parent Plus loan, and her second daughter is considering starting college this fall. Mia is worried that her monthly payments will be unaffordable, especially since she's expecting a new tuition expense. Let's go to the next slide. So the question is, true or false, Mia is eligible for the SAVE plan and will automatically receive the lower monthly payments. The answer is false. So Mia's Parent Plus loan is not eligible for the SAVE plan. So direct loans for graduate and undergraduate education, direct grad plus or direct subsidized loans, not loans that pay back Parent Plus loans or not Parent Plus loans themselves, are not eligible for SAVE. So for a Parent Plus borrower who has a Direct Plus loan or a FEL Plus parent loan, they can consolidate into a direct consolidation loan, and then they'll be able to repay that loan through one of the income-based repayment plans, and it's called Income Contingent Repayment, the ICR plan. The ICR plan is generally the least affordable of the IDR plans, but it is a plan that's available to Mia and may be helpful to her, especially if she's trying to get public service loan forgiveness. You can use Loan Simulator to see all the repayment options available, so she should check that out, and then she'll be able to choose the payment plan that makes the best sense for her situation. Let's go next slide. Okay, so now we're going to talk about IDR plans. Well, we talked about those, and we're going to talk about how you can actually apply for IDR. And I think, oh, it's not the moment I do my demo, sorry. So IDR plans match your monthly student loan payment to a reasonable amount for your income and family size. So we saw that with SAVE. So there are currently 4 IDR plans: the SAVE plan, which replaced the Repay plan, the Pay As You Earn plan, the Income-Based Repayment plan, IBR plan, and the Income Contingent Repayment plan, the ICR plan. Remember, the ICR plan is a plan that's available to parent plus borrowers who consolidate. The rules for each loan for each type of repayment and who qualifies are very specific. You can find out more about that on our website. Go to the next slide. But those are the 4 options. So now we're going to talk about how you actually apply for IDR. And we're going to do a demo. All right. Okay. So we have done a lot. In addition to improving income-driven repayment, the payment count adjustment, which has brought hundreds of thousands of borrowers forgiveness who weren't able to get it before. And in addition to the SAVE plan, we have made it easier than ever to apply for an income-driven repayment plan. So I'm going to show you just how easy it is by doing a demo. So I'm doing this demo right here on StudentAid.gov. So the first thing you're going to see when you start to apply is what you can expect. You're going to have to confirm contact information. You're going to have to review your loan info. You're going to confirm your personal information. You're going to transfer your federal financial information, review your payment plan, or switch to a new one. And you're going to agree to some terms and conditions. Sounds easy, right? We're going to click continue. The first thing it's going to ask you for is authorization to retrieve your federal tax information. This is a really big thing. We really encourage you to do this because if you do this next year, when you have to recertify for IDR, because you have to recertify every year, it will automatically do this for you. So it's going to automatically take your information from the IRS, create your payment based on that, and it will automatically update next year. So you don't have to do anything. You don't have to recertify every year. So if you file taxes and if you are comfortable, we really encourage you to agree and approve this this piece where you are consenting to take your information directly from the IRS and have your payment calculated based on that. So I'm going to click approve. Okay. So this is a demo, and I'll just say I clicked approve, but we're not going to be able to do it because it's a demo. So there's not actually a JDO that we are using. But if you clicked approve, some of the next steps would be there. So I'm clicking approve. I'm checking my borrower information because that's how it's going to find my tax information, my date of birth, my social security number, making sure my contact information is correct. If everything looks good, scroll down. I'm going to click continue. Then I'm going to review my loans. It says I have $28,000 in student direct loans. It's 4.6% interest rate. That looks right to me. I don't have any ineligible loans. All my loans are eligible. So I'm going to click continue because everything looks good. And now I've confirmed my contact information, loan information, and I'm just a few steps away. I'm almost done. So now I'm going to confirm my marital status. If I'm married or not, I'm going to put no. Then it's going to ask me about my family size, and it's going to also ask me if my family size is going to change in the next 12 months. So it's asking me if what I put on my taxes, because I clicked approve, is going to change. And I don't think it will, so I'm going to put no. But if you think that you're going to, your family size is going to change, you're going to get married, you're going to have kids, you're going to just change the size of your family, then you're going to put yes. But I'm going to put no. And then it is going to securely import my information. So because I clicked approve to import my federal tax information. So it's doing that, or it would do that if we weren't in a demo mode. So since we're in a demo mode, we're not actually going to access financial information. So this is what would happen if you click no. But if you click yes, you would have just went on and you would have saw repayment plans. So because we're in a demo, it's going to ask you a little bit more questions because it's not taking in your FTI, so your federal tax information. So if you had clicked no, it's going to ask you about your dependents, if you have children or not. I'm going to say 0. It's going to ask if you have any non-child dependents, so any other people or relatives living with you who receive more than half of their support from you. I'm going to keep mine at 0, but you can change either of these if you need to. Then it's going to ask me if I've had any income changes since my last tax return. So has my income stayed the same? Has it decreased significantly since your last tax return? That's really the most important thing. Has your income decreased? Because we want to make sure that whatever is calculated is not unaffordable for you based on your current situation. So the big question to consider here is, has your income decreased significantly since your last tax return? And it's first going to ask you, did you file taxes for either of the 2 most recent tax years? I'm going to say yes. And then it's going to ask me that question, has it income significantly decreased? I'm going to say no. It's going to ask me if I had taxable income. I'm going to say yes. And it's going to ask me to provide income documentation. So because in this demo, we couldn't technically approve, we weren't able to bring in the tax information. And if you do not consent to securely importing your tax information when you do this, you're going to have to upload some documentation. So to show your income. So a couple of things that you can do is a W-2, a pay stub, an employer letter, or a bank account. Right now, you can also self-certify your income, and you can do this by creating a document. It'll give you some information right here, and then you can upload it. You can also work directly with your servicer. So you can actually call your servicer and self-certify your income right now. You can do that for the next 6 months. 6 months after the payment pause, you'll be able to self-certify your income. This is something just to make it to ease transition back into repayment for borrowers. So you do have this option. If you don't have any of the other things, feel free to either upload or you can call your servicer and verify it over the phone. So you'll upload a file. We'll click continue. Now, before in the real application, if you don't upload a file, it will not let you click continue. So you will have to upload something. Then it's going to ask me to round to the nearest amount of my adjusted gross income. Now, you may be wondering, what is your adjusted gross income? And it's asking you this because it bases your payment on your income and family size. So you can estimate your adjusted gross income, which is commonly referred to as your AGI. It's your family's wages, salaries, interest, dividends, etc., minus certain deductions from income as reported on the federal income tax return. So you can learn more about that here, but it's basically your taxable income. And so you'll estimate that. You'll write in here, I'm going to just estimate $40,000. I have a loan balance of $28,000. And so now based on that, it's going to estimate my payments. Because again, I did not import my information, so I had to upload documentation. Now it's going to estimate my payments, and now I can see my options for repayment plans. So the first thing that I see is the Saving on a Valuable Education Plan, the SAVE plan. And it says that's my lowest monthly payment. And you'll see here that my monthly payment will be $60. I'll pay it off by September 2043. I'll get $24,000 forgiven. I'll pay $24,000 over the life of my repayment term. And I'm able to click and view details. I can learn more about what that means, the loan term, the eligible loans. It'll talk about advantages and disadvantages. I can also look at the other IDR plans that I might be eligible for, because I'm also eligible for IBR, but my monthly payment would be much higher, as I see here, and I would pay it off sooner, but I wouldn't get anything forgiven. So something also I want to pay attention to. It says also I can do income contingent repayment. My monthly payment will be $201, so much higher. And again, I wouldn't get anything forgiven. So you can find all of that information. You can click view details for each one. You can even see the ineligible plan. So I'm not eligible for the pay-as-you-earn plan because of the rules for that. And then I'm going to pick the one that I think is best. And I think it's going to be SAVE, right? I've reviewed everything, so I'm going to click continue. I'm going to review my application, make sure everything looks right, my contact information about my loans, my marital status, my financial information, any changes I've made. I'm going to click repayment plan. So I would have requested the SAVE plan. This is a demo, so it doesn't exactly look like that, but I requested the plan with the lowest monthly payment, and that was SAVE. I'm going to click continue. I'm going to read all of these things that make sure I understand everything I've put in and everything is correct, and I think I've done my best. I'm going to confirm and certify. And I'm going to click continue. And that's it. I've completed the IDR application. I've completed the demonstration. And I think that took like, what, 6 or 7 minutes. So it's that easy and that quick. If you have everything you need at your fingertips, or if you consent to the bringing your tax information, you can fill out the IDR application that quickly. Now I'm going to turn it back over to the PowerPoint and we're going to finish up. Okay, let's talk a little bit about next steps. So a couple of potential next steps. As a reminder, you want to set up your account on StudentAid.gov if you haven't already, or update your contact information if you have, and if it's changed. And you want to do that with your loan servicer as well. You want to review loan forgiveness options. And you want to compare IDR plans. You can use our loan simulator to do that, or you'll be able to do it right in the IDR application. But if you use our loan simulator, it's another good place to go because it'll show you plans other than just the income-driven repayment plans. And so it'll give you more options and give you other things to think about. And you want to enroll in auto pay if possible. So you can get that, so you can stay on top of your payments and get that 0.25% interest rate deduction. Let's go to the next slide. I think it's time. Not time for Q&A. Just a reminder, avoid student loan scams. We want to remind you that you never have to pay for help. You can call your servicer, you can call FSA, you can call our contact centers. Don't pay anyone to help you with your student loans. You don't have to do that. Never give someone your FSA ID, your account information, or passwords. We are not going to call you. We nor our servicers are going to call or email you asking for this information. We're not going to text you asking for this information. So never give that over the phone. Don't give any personal or financial information to an unfamiliar caller. If you don't know, if you're in doubt, hang up and call your servicer. And if you do think you've been contacted by a scammer or you've actually been scammed, you should report that immediately to the FSA Ombudsman and to the FTC, the Federal Trade Commission. And finally, we really encourage you, don't refinance federal student loans unless you know the risk. So when you refinance federal student loans into private loans, you lose all the protections of federal student loans. You lose access to all of these wonderful programs we talked about. So make sure you understand that when you're thinking about whether or not to refinance and whether that makes sense for you. Next slide. There's a bunch of additional resources, some of the things we talked about today. Next slide. You can be able to find this webinar and others on the FSA Outreach YouTube channel. So go ahead and subscribe today. Next slide. And we're going to do some Q&A.
Oh, yes, we are. Thank you so much, Ashley, for a wonderful presentation. Let's get into a couple of questions that we have. So first question that we have, can I start making payments while I am in school?
So you can, but if you are in undergrad, it's your first time in repayment, like you're not, that time won't count towards things like IDR forgiveness or public service loan forgiveness. If you're in grad school, you can opt out of your in-school deferment. So you can make a payment anytime. And some folks do because on some of your loans, you're accruing interest and you want to take care of that. So yes, but you should just make sure that it makes sense for you long-term.
Great question. Great answer. So here's another question. Parent plus loans. Is the parent solely responsible for both parent and student or just the parent?
So the parents are responsible for the parent loan, the loan that's in their name. And so if a parent plus borrower is trying to get PSLF, it's for their loan and it's for their employment. And the student is responsible for their own loans.
Excellent. Here's another question here to talk about grad school and deferment. So if you're going to attend grad school after your undergrad degree, do you defer your undergrad loans? And if so, does the interest stop accruing while you're in grad school?
So when you go into a program more than half time, usually your loans will automatically be put on in-school deferment, so you wouldn't necessarily have to worry about that. And if you have unsubsidized loans, yes, they would still continue to accrue interest, but you would not have to make a payment.
Excellent. So you covered this in the presentation today, but just so everyone, just a refresher, do SAVE plan payments count towards PSLF?
Yes. The SAVE plan is an IDR plan. IDR plan payments count towards PSLF, even if they're $0. So if you put in your information and it tells you get a $0 payment, those months still count towards PSLF. You just have to certify your income you just have to certify your employment using our PSLF help tool. So you still have to show you have that employment and that you're meeting the other criteria, but absolutely saved payments count towards your 120 for PSLF.
Excellent. So here's another one. If we have a current student currently in college, should they apply for the SAVE plan now or wait until they graduate?
Students, so they would not be able to apply until they enter repayment.
Excellent, excellent. So going back to the account adjustment, so there was a question regards to applying to PSLF. So someone applied for PSLF and they consolidated their loans. And then they wanted to know, will those payments count prior to the account adjustment, or will they be waiting until the one-time account adjustment?
If you recently consolidated your loans, if you recently consolidated your loans and you're applying for a PSLF and you submit a PSLF form, you will start seeing updates in the next couple of months, but the actual account adjustment is going to occur next year. If you consolidated in for the PSLF waiver, so back in 2022, you have already started to see adjustments, and you will continue to see those updates, and will continue to do so. But other folks, it may take a little longer.
Excellent. So do we have to apply somewhere for our payment counts to be adjusted, or will it happen automatically?
Really good question. So for most folks, you don't have to do anything. If your loans were on the payment pause, you're automatically going to get the account adjustment. Now, the folks who do have to do something fall into a couple of categories. First, if you have any type of FEL or Perkins loans and you're trying to get PSLF, even if those loans were on the payment pause, you need to consolidate. If you have loans that have differing periods of repayment, so one loan's been in repayment 18 years, one loan's been in repayment 16 years, you might want to consolidate, because in that entire consolidation loan would get that 18-year time period. You want to keep in mind, though, that that could determine if there's grad and undergrad, if there's Parent Plus, that could determine which IDR plans you have available to you and what your term is. But you might want to consolidate if that will get you closer to forgiveness. But most folks, if your loans under the payment pause, you don't have to do anything. If you have direct loans, especially, you don't have to do anything.
Excellent. So we're going to go back to the SAVE plan and enrollment, because I think there needs to be some clarification here. Students are still asking, can they apply for the SAVE plan as a current student? So when is repayment status when you say that?
So as a current student, we want you to be worried about your studies, right? So you're not thinking about repayment yet. So the time for you to apply is when you're actually about to enter repayment, which is at the end of your grace period. So 6 months after you leave school, that is when you'll get a letter from your servicer telling you about your first bill and things like that. And so at that point, you've automatically been put on the standard plan. And at this point, you can decide, I want to go and get on a more affordable plan and sign up for the SAVE plan then. But right now, you cannot apply for anything because you're not actually in repayment. The SAVE plan is a repayment plan, so you have to actually be in repayment to access it.
Excellent. So here's a question for more explanation. It seems like we have a lot of first timers on. They're asking, can you explain what deferment means?
Yes. So there's a couple of types of deferment. I'll just say generally that deferments and forbearances are types of what we call short-term relief, ways that if you are unable to make a payment and you might have it for different reasons, like you have an economic hardship, there's deferments for that. There's in-school deferments. There are military-related deferments. There are other types of deferments. And so in general, the difference between deferments and forbearances are, on a lot of deferments, you are not accruing interest. And a lot of forbearances you are. It's really more complicated than just deferment forbearance. So, but we'll drop a link in the chat. I think the important thing to know, though, is that depending on what type of deferment or forbearance you're on, it may not count towards PSLF or IDR forgiveness. And so you want to be keeping track of that as well. And you can find out more about all of those statuses on StudentAid.gov.
Excellent. So here's a clarifying question about PSLF. If they're currently working for a qualifying employer, but currently in school deferred, can they start making payments, and will those payments count?
So only if they would have to be able to opt out of that in-school deferment, which is only available to grad students who have previously been in deferment, or if you go back to undergrad and you've previously been in deferment, you can opt out of in-school deferment, but you would have to do that first to start getting credit for PSLF.
Wonderful. Let's go back to consolidation. When should they consolidate in order to be eligible for the one-time account adjustment?
So we're encouraging folks to do it by the end of the year, just to make sure that everything goes through, because it can take like 60 days or so for consolidation to go through. So we really encourage you to do it by the end of the year.
Wonderful. And I think there's maybe one more question here. Let's go with the one about IDR payments. So if someone is saying they're struggling with making a payment now and they want to review IDR to see what's the best option for them, where should they go to consider IDR plans?
You should definitely check out Loan Simulator. That's a great place to go to estimate your plans. Also, when you go through the StudentAid.gov IDR application, you'll be able to see all your options there. But Loan Simulator is a great place to start to review all your repayment plan options.
Excellent. I think we've covered them all here.
Wow.
Yes, it seems like there were
Pretty
some repeat
efficient.
questions here. So I'm going to take a quick look again. Well, there's one question regarding from a parent that's asking if they can support their student by making payments, or is that not allowed?
Absolutely. You can, yes. If you were able to support your student, absolutely, and help them make payments, you can. We are not looking at where the checks came from. We just want to make sure those monthly payments are satisfied. So absolutely.
And we do have one more question about SAVE or just IDR plans in general. They're saying, is there any penalty or disadvantage to paying off your student loan earlier or making more payments, more than a required amount?
So if your goal is to pay off your loan as fast as possible, then absolutely not. That's your goal. Some folks' goal is to make sure their payment is as low as possible, as affordable as possible. Some folks' goal is to maximize their ability to get PSLF or IDR forgiveness. So it really just depends on your goal, and the drawbacks would be for you based on what your goals are.
Here's another clarifying question regarding unsubsidized loans and interest. So during school for unsubsidized loans, is that interest occurring? And if they make a payment, does it go to just principal?
If you have unsubsidized loans, yes, they are accruing interest. And if you make a payment, depending on how much the payment is, some of it would go to interest first and then principal.
Excellent. Okay, I think we got them all. So thank you everyone for joining us for this last session of the first day for Financial Aid Bootcamp. We would love your feedback. Please take a moment to screen the PowerPoint slide right now so that you can provide feedback for today's session. If you would like to review the recording of this session, please know it will be available tomorrow at 6 p.m. on our YouTube channel. You can go to youtube.com/FSA Outreach. Again, that's youtube.com/FSA Outreach. I will put that in the chat here for everyone. Also note that you can also request the PDF of the presentation slides in the description of the videos as well. So we look forward to you joining us for day 2 for the Financial Aid Bootcamp. We will be starting off tomorrow talking about the Fresh Start program, how to avoid default, and also the loan simulator. So if those who have questions about income-driven repayment plans and want to know more about how to compare plans, tomorrow at 1 p.m. Eastern Standard Time will be the best time to do so. Also, at 3 p.m. tomorrow, we will be covering how to select a best college using College Scorecard. That is tomorrow at 3 p.m. Eastern Standard Time. And then tomorrow evening at 8 p.m., we will be doing a repeat session, which is the 2024-25 FAFSA prototype preview, which will be a focus on independent students. So again, we hope to have you join us tomorrow if you can. We will put this link in the chat as well for our Eventbrite if you would like to register for any of those for tomorrow. Thank you so much, Ashley, and thank you all. Have a great night.